This video is for information and general guidance only. It is not personal mortgage advice. We are authorised and regulated by the Financial Conduct Authority. Your home may be repossessed if you do not keep up repayments on your mortgage. We also follow a no-pressure, no-obligation approach. You're welcome to ask questions at any time, and there is no requirement to use our services.
Failing the High Street Mortgage Affordability Test. What to do next? It is one of the most frustrating phone calls you can ever receive from a bank or a mortgage advisor. You have paid your mortgage perfectly every single month for years. You earn a good salary and your current deal is coming to an end. You want to shop around for a better interest rate with a new bank, which is what we call a remortgage, or perhaps you want to borrow a little extra from your current lender to improve your home. Then the voice on the other end of the line sighs and says those dreaded words. "I am sorry, but according to our calculator, you don't fit the criteria." It feels completely backwards, doesn't it? You are already paying for the house. You have already proven you are reliable, so why are you suddenly being turned away? To understand why this happens, we have to look at the difference between staying with your current bank and moving to a new one. If you stick with your existing lender and just swap to a new rate without borrowing more money, it is called a product transfer. In the UK, a like-for-like product transfer rarely requires a new cheque because you aren't changing the loan amount. But the moment you try to remortgage, meaning you try to move your entire mortgage to a completely new lender to find a cheaper deal, that new bank treats you as a brand new applicant. Alternatively, if you stay with your current bank but ask to borrow even a little bit extra, they have to re-evaluate your whole financial life. And this is where millions of borrowers run straight into the strict world of automated high-street stress testing. Think of a stress test as a financial fire drill. When a new bank assesses a remortgage, they do not just look at whether you can afford the repayments at today's interest rates. By law, they are required to test your finances against an imaginary scenario where interest rates rise significantly in the future. They have to ask their systems, if interest rates skyrocketed to 8 or 9%, could this person still buy food, pay their utility bills, and cover this mortgage? Even if the actual rate you want to lock in is much lower, the bank's automated system must judge you on that higher simulated rate. If your income doesn't stretch to cover that artificial calculation, the computer simply cannot approve the application. Furthermore, every lender has its own unique rules and types of cases they are comfortable lending on. Mainstream high street banks are set up to process huge volumes of standard applications
efficiently, which means their automated systems love simple, predictable payslips. If you are self-employed, if you rely on regular overtime, or if a portion of your earnings comes from bonuses or commission, a high street lender might choose to take only a small percentage of that money into account. They aren't trying to be difficult, they are simply applying their specific boundaries to a complex financial profile. But here is the important thing to remember. A rejection from one mainstream bank is not a reflection of your true financial health or your ability to pay. The UK mortgage market is incredibly broad, and different lenders look at things very differently. This is where specialist lenders come into play. Because they focus on a smaller volume of clients, these institutions don't rely solely on automated computer scores. Instead, they use manual underwriting, which just means a real human being with experience actually sits down and looks at the context behind your bank statements. A human underwriter can take the time to see that your income is stable, even if it comes from complex or variable sources. They can recognize that your bonus has been paid consistently for years, or look at your most recent year's tax returns if your business is growing rapidly. More importantly, many specialist lenders use affordability calculators designed to accommodate these exact scenarios. They might offer more flexible guidelines or allow you to look at a longer mortgage term to bring your monthly commitments into a comfortable zone. If you have recently failed a high street affordability check while trying to remortgage or borrow extra, the worst thing you can do right now is blindly apply to another major bank. Every time you do that, it can leave a hard credit check footprint on your file, which can inadvertently affect your credit score. Instead, take a step back. Gather your paperwork and speak to an independent mortgage broker. A broker understands how different lenders view different situations. They can look at your exact income layout, run the figures through specialist systems, and pinpoint exactly which lender's guidelines align with your unique situation before any formal application is ever submitted. You do not have to accept a single automated response as the final word on your homeownership journey. There are alternative routes, and there are lenders who want to listen to your story. If you are ready to look past the high street and explore your actual options, reach out to the team at ZAS Mortgages and Protection Limited. You can call us directly on 0800 061 4173 or send a quick message on WhatsApp to 07383 0011 for a completely free initial assessment. Let us take a look at the real numbers together.